capitalism is about creating capital for the capitalists, if that's not too many capitals in one sentence.
Welcome to your financial library, where we talk about the books that will help you to become rich. Today's video is about The Little Book of Common Sense Investing, written by John C. Bogle and first published in 2007. This is the sixth book by Bogle and the third book in Wiley's Little Book, Big Profits series. This book is a straightforward guide to building wealth through the stock market and achieving financial success with minimal risk. It is divided into 18 chapters, showcasing the strategy Bogle himself used to establish his company and generate profits for its clients. Bogle's message is simple. The best way to grow your money is to invest in low-cost index funds and stay invested for the long term. By following this approach, you can avoid common investing mistakes and let your money work for you over time. John C. Bogle, the founder of the Vanguard Group, is famous for creating the first index mutual fund in 1976. His goal was to make investing affordable and accessible to everyone. Known as the father of index investing, Bogle believed in keeping things simple and fair for investors.
What we should be doing, and what we have been doing, is putting the investor first and innovating for the investor and not for ourselves. The sole role of the producer is to serve the consumer. Adam Smith, 1776.
He spent his life teaching people that you don't need to be a stock market expert to succeed. You just need the right tools and mindset. Bogle starts the book by explaining why most investors struggle to beat the market. Many people rely on active investing, where fund managers try to pick winning stocks or predict market trends. However, this approach often fails because of high costs, frequent trading, and unpredictable markets. For example, when you invest in an actively managed mutual fund, you pay management fees, which can be as high as 1 to 2% of your investment each year. These fees might not seem like much at first, but over time, they take a big chunk out of your returns. On top of that, active funds trade stocks frequently, which adds more cost and creates taxes on any profits. Bogle shares research showing that over 30 years, more than 90% of actively managed funds perform worse than index funds. Why? Because the costs of active investing eat away at any extra returns the managers might earn. So, what's the solution? Bogle recommends index funds. These are funds that don't try to beat the market. They simply match it. For example, an index fund tied to the S&P 500 owns small portions of all 500 companies in that index. This approach has several major advantages. 1. Low costs. Index funds are passive, meaning they don't require expensive managers to pick stocks. As a result, their fees are incredibly low, often less than 0.1%. 2. Diversification. By investing in an entire index, you automatically spread your money across many companies. This reduces risk because your success doesn't depend on a few stocks that are performing well. 3. Market growth. Over time, the market tends to grow. Even with ups and downs, the stock market has delivered average annual returns of 7 to 10% over the long term. Index funds let you benefit from this growth. Bogle emphasizes that index funds remove the stress of trying to outsmart the market. Instead, you simply ride the wave of long-term market growth. One of the most powerful lessons in the book is about compounding. Compounding happens when your investment earnings generate even more earnings over time. This creates a snowball effect, where your money grows faster and faster the longer it stays invested. Here's an example. Imagine you invest $10,000 at an annual return of 8%. After 10 years, your investment grows to $21,589. After 20 years, it becomes $46,610. After 30 years, it's worth $100,627. The earlier you start investing, the more compounding works in your favor. But fees can slow down compounding. If your investments lose 2% each year to fees, your $10,000 would only grow to $60,000 in 30 years instead of $100,000. This is why keeping costs low is so important.
Watch out for costs. A typical mutual fund takes around 2% equity fund out of that 4% return, leaving you with 2%. And the index fund, total market index fund, S&P 500 index fund, is going to take less than 5 basis points. That's a big difference. We have a little table about this in the book. 2% is a lot more than 5/100ths of 1%.
To take full advantage of compounding, start investing as early as possible. Reinvest any dividends you earn so they can grow too. Choose investments with very low fees. Bogle warns investors about common traps that can ruin their returns. Two big ones are trying to time the market and letting emotions drive decisions. 1. Timing the market. Many people try to guess when the market will go up or down, but even professional investors often get it wrong. Instead of trying to time the market, Bogle advises staying invested for the long term. History shows that the market always recovers from downturns. If you sell during a crash, you lock in losses and miss out on the recovery.
But the idea of an all or nothing approach, well, I sold all my stocks yesterday. You're going to have a long, hard investment lifetime. Who can do that?
2. Emotional investing. Fear and greed often lead to bad decisions. When the market drops, people panic and sell. When it rises, they get greedy and buy overpriced stocks. Bogle's advice? Stay calm and stick to your plan, no matter what the market is doing. In order to avoid these mistakes, set up automatic investments so you don't have to think about timing. Focus on your long-term goals instead of daily market news. Remember that short-term losses are normal and temporary. Bogle provides clear, actionable steps for building a successful investment strategy. 1. Invest in low-cost index funds. Choose funds that track the entire market, like the S&P 500 or a total stock market index. These funds offer broad diversification and low fees. 2. Keep fees low. Look for funds with expense ratios under 0.1%. Avoid funds with high management fees or frequent trading. 3. Diversify your portfolio. Spread your money across different asset classes, like stocks and bonds, to reduce risk. A common rule is to hold a percentage of bonds equal to your age. For example, 30% bonds if you're 30 years old. 4. Reinvest dividends. Many index funds pay dividends. Instead of withdrawing this money, reinvest it to boost your compounding returns. 5. Stay consistent. Invest regularly, no matter what the market is doing. Automatic contributions make this easy and remove emotional decision-making. 6. Don't chase trends. Avoid hot stocks or funds that promise high returns. They usually involve higher risk and fees. 7. Rebalance occasionally. Over time, some investments may grow faster than others, changing your portfolio's balance. Rebalance once a year to keep your investments aligned with your goals. And if you take these steps and all the other advice from the book seriously enough, well, you can already start calling yourself a wealthy person.
That's what capitalism is, the incentive to get rich, if you will.